Gold has been strongly affected by Ben Bernanke's comment, saying asset purchases may be reduced later this year as the US economy recovers. Now Robin Bhar, who is responsible for metals at Societe Generale in London, is on the line. Robin, in London trading, gold dropped to the lowest in more than 2.5 years. This actually exceeded a drop in April. What do you think about this fall today, Robin?
It doesn't surprise us because we've maintained, even prior to the collapse in April, we've maintained a very negative view on gold. And this is in line with the bank's general view on the global economy, that we think it is returning to a more normal situation led by the ongoing recovery in the US. And associated with that, we had always expected the Fed to start easing off the QE pedal later in the year. And with that, we did foresee a continued rise in bond yields in the US. We have a target of 2.75% for the 10-year US Treasury by the end of the year, and that will see a stronger dollar, and that will hasten the exit out of gold by investors who are holding gold in the ETFs. And we see really no case to be wanting to be long of gold in an environment which is improving, where the tail risks of a euro breakup or fiscal headwinds in the US and so on, we see those tail risks fading.
And in terms of trading patterns, what are we currently witnessing?
Well, the trading pattern right now is liquidation from gold participants in the spot market. So they're selling long positions. They're probably, we suspect, going short as well, going short on the futures market, going short spot gold as well, because they do see lower prices. So I think that continues. What will be the key for gold today primarily will be how gold behaves. Where is the next $20? Will it allow, if the next $20 is positive, that means gold could hold above psychological support at the 1300 level, because that's a big number level, if you like. There's probably not very much real support, but psychologically provides support. But if gold fails to hold at 1300 and falls below that, that will hasten more liquidation, hasten more selling. What's worrying for gold is that we've lost $50 or so in the first few hours of the trading day, and we've still got the bulk of the trading day to get through. More importantly, we've got the openings of the US markets, where the full impact of the Fed statement has yet to be seen, because there perhaps wasn't much opportunity for US players to do very much after the market close yesterday. Maybe we'll see more follow-through, having digested the full impact of Bernanke's comments. We'll see the full impact in the gold market later today.
And at what pace do you see the US recovering, and how do you think this will actually affect the performance of gold?
The US economy is recovering, not at a very fast speed, but it's a gradual recovery, because you've got some fiscal headwinds. The sequester has kicked in earlier in the year, and that's slowing the economy. But we think it will manage to shrug off that by the second half, and we see a reacceleration. So stronger growth in Q3 and Q4 of the year, and therefore that has allowed the Fed to dial back on QE, and we think will announce in September, if not sooner, that they will begin to actually ease out of QE, buy less assets. They're buying at the moment $85 billion worth of assets. Each month. We think that could be reduced to maybe $65 billion by September, and maybe each month after that reducing it by anywhere between 10, maybe 20 billion a month less after that, and not buy anything at all possibly by the middle of next year, and then maybe look at reversing QE, reversing the liquidity, the huge liquidity pumping that's taken place over the last few years, putting that into reverse. So we do take a very optimistic view on the US economy, and even if it doesn't reaccelerate, just the fact that it's creating jobs, as we saw in the most recent non-farm payrolls, it just has to continue, at the pace that we've seen recently, for those expectations, I think, to be met, and that has very serious negative consequences for the gold market. We are making the assumption that we think gold will end Q4 at an average of $1,200, so that implies, certainly trading below $1,200. We have an average for next year at $1,150. So the average for the whole of 2014 at $1,050 per ounce. So that would suggest at some stage we drop below 1,000. We have gold trading in 3 digits and below $1,000 at some stage. So we think gold has been in the bubble. That bubble has now been pricked and is in the process of deflating. History tells us when bubbles deflate, they can deflate very quickly and very substantially, and that is why we're not being surprised by the collapse now for the second time in gold.
Great, thanks for that, Robin. Well, viewers, I also had a look at the SNB rate decision today with an expert from ING, so do check that out. But for now, goodbye.